Evening, everybody. So that was a video on the National Financial Literacy Quiz, a joint initiative of NISM and SEBI for the undergraduate and the postgraduate students. So I'm Rasmeet Kohli, Senior Assistant General Manager from the Investor Education Department of National Institute of Securities Markets. NISM is the capacity building initiative of SEBI. And at NISM, we work in 5 broad areas, primarily the long-term and short-term academic programs, the certification for market intermediaries, the e-learning programs, the training programs for working professionals and the academia, and various investor education initiatives. So, and one of the initiatives is on the investor education webinar, which we hold it on a weekly basis. So to begin with, we had introduced a 5-part series on foundations of financial planning, which was scheduled for every Thursday this January. And the series began on January 1st with Mr. Bihari Lal Deora, who laid the groundwork by discussing fundamentals of personal finance. So in his session, he had discussed about goal-based planning, about insurance, retirement, and investment planning, and various other aspects also. After this, there was a second episode which was held last Thursday, and it was on understanding risk and returns. Now, this was conducted by Mr. Harsh Rungta, and it helped participants to understand the trade-offs which are inherent in financial decision making. Today, we move to the third episode, which is on asset allocation made simple by Mr. Shailendra Kumar. So, to introduce Mr. Shailendra Kumar, he has co-founded Fin A to Z Right Focused Investment Private Limited, which is a SEBI-registered investment advisory company. He's a member of the Association of Registered Investment Advisors, ARIA, and has an overall industry experience of over 26 years. He has received a certification in financial markets from the Yale University, USA, and did his master's in financial management from NIMS, Mumbai. He holds his graduation BE degree in electronics and communication from IIT Roorkee. Mr. Shailendra has over 12 years of experience in investing and managing various financial products for the different profiles of Indian investors. Fin A to Z works with 700 plus customers, and he manages total assets of rupees 1100 crore. Mr. Shailendra also conducts financial awareness sessions in Fortune 500 companies like Palo Alto, Intuit, and Schneider, and others like Juniper, ABB, Reliance Retail, etc. He is on a mission to improve people's financial lives by spreading awareness about personal finance. With this, I hand over the session to Mr. Shailendra Kumar.
Thank you, Rasmeet. Thank you very much for the kind introduction. Just trying to share my screen. Just first confirm that you guys are able to hear me and my screen is visible.
Yes, sir, it's visible.
Cool, good. And one more setup thing in terms of people can comment, because I can see Q&A, but can people comment also on the in the webinar?
So they can write their questions in the Q&A section.
Okay, got it. Perfect. So without any delay, let's start. This is the third in the series in the financial foundation of financial planning. This is allocation. This is a topic on asset allocation. And this topic is very, very important topic. And I'll straight away jump into this, that why it is important. So maybe some of you have known about what is a balanced diet, right? Everyone talks about asset allocation, it will have something, and you guys want to know about it. So I'll take a parallel, I'll take a step back and say, you talk about a balanced diet. If you want a good healthy diet, what do you need, right? You typically need carbohydrates, you need protein, and you need salad, and some amount of other things. And that constitutes a good balanced diet. Similarly, in equity, we need similarly in good portfolio and financial planning, you need a good asset allocation of various assets. So asset allocation is a very, very important parameter to determine and to have in your portfolio, to have a long-term portfolio, which is risk, which will determine the risk, return, and volatility. And it becomes very impactful because you don't have to worry about any market timing, you don't have to worry about selection of products, and you can actually continue with your long run journey. So why do we do asset allocation, right? So people will also talk about many things, right? I have written 4 parts here about controlling the downside risk, creating a predictable portfolio behavior, having to avoid taking any emotional decision making, and to improve the consistency of return in the long run. All these 4 parameters can be achieved if you have a proper asset allocation. Now, I'll come back to the example of a balanced diet where you don't need, say, only if you like taste, right? You will say, I want something very nice to eat. Let us say you want paneer ka sabzi with some roti, and that's all you want to have. You will not like to have, say, any other thing in addition to that. That typically people won't do. They will have a mix of things what they want to have. Similarly, you want to do the same thing in your portfolio as well. But then mathematically, how does it affect you? What is the thing which is making a difference in your portfolio when you have asset allocation? So I'll take an example here. It's a very simple example and I have simplified it to say, let us say we have equity and we have gold. And equity, and we both start at say 100 rupees. So equity is at 100 and gold is also at 100 rupees. With this red line which is showing the equity movement which has resulted in a 1 year period approx, it has gone up to 130 rupees. Similarly, gold has gone from 100 but it has gone down. Right now the gold has gone up. Everyone will say that no, gold is going up nowadays, where it is going down. But let us say in this example, it has gone down and it is below 80. Now, I want to know what is the kind of return which you will have if you have invested equal amount of money in equity as well as in gold. So I'll take to the next slide. So if suppose we are having 50% allocation in both equity and gold, the performance individually, equity is given 23% positive return, while gold has given minus 26% return. In a 50% allocation, what will happen is it will be average of the two. That is 23 plus minus 26, which is minus 3 by 2 minus 1.5% return in your overall portfolio. But then the question is, what is the downside volatility? Now, when we talk about any investment other than FD, you have to understand that if you are getting any return which is higher than FD, you are taking some risk. Whether you have understood that risk or not understood that risk is a different matter. But you are taking some risk to get that extra return. That extra return comes with some downside volatility. So in our previous example, equity has gone down to 80, but it has come up. That's another thing. But say gold has come down, but it has stayed down. So that's the probability, or that's the downside risk which you are having in your investment. So the question to you, I have a quiz question and I want you guys to answer this question. That what is the value of downside volatility of the combined portfolio, that is 17.2 and 8.4? Will it be average as the returns average? Will it be lower than average or will it be higher than average? So as you have seen, performance is average of the two assets. How is the downside volatility? How it will be? So maybe people can start voting onto it. I'll just give you 30 seconds.
So is it
Okay, I'll
the
close
result?
the poll. Sahil, may I know the results?
Yes, sir. So, sir, 43% of the attendees have selected first option, that is, no, it's lower than the average.
Okay,
43 has selected this B option, that is, no, it's higher than the average. And 50% has selected the third option, that is, yes.
correct. So, as most of you have answered it yes and said that it will be equal to the average. So, unfortunately, your answer is actually wrong. So, please pay attention to this. because this is the only free lunch which is available in the financial market of investments, which is proper asset allocation actually will make the risk lower than the average. It is lesser of the two, right? So mathematically, if you see, this is what is happening. When you are having equity and gold, their average return is minus 1.5, but the downside volatility is lesser than the two. This is the only free lunch, and this is the main technical reason why you should be having a proper asset allocation in your portfolio for your long-term goals. So if you see in a graph, gold lies here somewhere in terms of the downside risk and the minus 26 as a performance and plus 23 and a higher risk in equity, but the combined portfolio lies somewhere here, which is an amazing outcome because you got a tool now to balance your portfolio with risk and return. It is again something like a diet in which if you like spices more or you want to have slightly higher, more protein, you can add something more. In equity also, in portfolio of investment in as well, you can actually have adjustment to return and risk accordingly if you understand the asset allocation. Now, another point, and some of you have attended the previous two sessions, so I have compressed the learning here in this, and I have not elaborated more, but I'll still tell you the main learning from the previous two sessions. The one learning which I think Mr. Hirsch has covered, that risk reduces with the tenure of investment. So when you are choosing for investments, you should understand very simple fact that there are three things which you should consider. That is how much risk you are ready to take, what is the tenure of investment, and then what is the return expectation. All these three things can be simultaneously high or simultaneously low if you want the probability of the return to be good. So what I mean is you cannot say ki I want high return, low risk and low tenure. Everyone wants that. Everyone has a desire to have that. But probability wise, it is not in your favor. Which probability is not in your favor to actually have such an outcome. So what you should be aspiring for to do is to have a longer tenure for higher risk for higher return expectation. Or other way around, you should have lower risk, lower return expectation for a lesser tenure investment. These are the two things which have high probability that you will be able to achieve. And risk, if you see the downside outcome in 1 year period in equity changes from -5 to +50%, but in a 7 year plus horizon, it becomes more stable and the range of return which you can have is positive. Firstly and foremost, you should understand if you're doing SIPs and there are many other strategies by which you can invest money into equity, you will get positive return in a 7 year plus time frame and up to 17%. Mostly 10 to 12% is what you should be setting an expectation for equity investment in a long run. So time in the market actually reduces risk by smoothing the return volatility. Next, I'll quickly cover the previous two sessions, very important learnings which they had. In the first webinar by Bihari Lal, the things which he has explained is a basics of financial plan about expenses, saving and investing, but he also talked about how the returns are different for various products and you understand the risk and the guaranteed returns, some common mistakes. And secondly, Mr. Hirsch covered about risk and returns. He has covered in depth about all the type of risk of credit, liquidity and market and the tenure of investment. And most importantly, what he covered was that you should be matching your individual risk appetite to the investment. This is very important thing to do. And once you do that, then the next question which obviously comes is how to choose these assets, right? And to match it to your own goal and your long-term journey. So for that, we have various asset classes in which you can invest, but let us see them one by one. First and foremost is equity, which is an asset class which is very good for a long-term growth. Second is your debt or a cash, and people also talk it about you have given some money, some loan, so that also is a kind of a debt. Here you are giving debt to primarily to corporates, and you invest via debt MF or via any other instrument. But these are considered as guaranteed kind of product because you have given someone, or like FD is kind of bank guarantee is there, and to up to a certain limit you will get such kind of a return, but still there is some amount of risk of people going default. So there is a different type of a risk, but then it's a different asset class. Commodity is another third asset class, and it is typically used for hedging. Whenever you are saying that market environment is looking very choppy, or there are geopolitical reasons nowadays, every 6 months or 8 months you hear one war or the other. Earlier it was Ukraine, nowadays it is Venezuela, and so on. So this commodity as an asset class acts as an hedge, and this is the main reason why right now gold and silver you are seeing is actually going up a lot. Fourth is real estate as an asset class. This is primarily used for diversification because this is a physical asset class. People are very comfortable to hold it, and what you have to understand is that this is also very cyclical in nature. Many a times it will not move at all for years together, but sometimes it will jump up very quickly as well, and sometimes there will be flat or negative returns as people have seen and faced it during the time frame of COVID. And in this, another thing which is to be seen about all these asset classes is they are all cyclical in nature. It's like when RBI is cutting rates, real estate will go up or is likely to go up in the next coming time. But when RBI is increasing rates, that time real estate can go down. So there is a correlation between the macro environment of the economics and the actual movement of these asset classes. So you have to understand that these are all cyclical. And if I quickly come back to my example of equity and gold, which I have shown you earlier, here also, if you see, what we have done is you will see that the equity has gone up and the gold has gone down. When the gold has gone up, equity has gone down. And when again equity has gone up, the gold has gone down. So what it is showing is, it is showing that if there is a negative correlation of the movement of the assets as respect to the each other, better it is for you, because you are going to gain from the various movements uh, of the particular asset class. Lastly, I have covered alternatives, which is like unlisted equity or some other asset class like crypto or some other thing which you may want to invest in. It is a bit of a again another asset class which is not related to the other asset classes, but then it provides you a bit of a diversification, but typically it involves a very high amount of ticket of investment. So key learning, all these type of asset classes will actually perform well in a very, very different economic cycles. So we have to be worried, or we have to be careful about what are the kind of cycles which these asset classes will be exposed to. Now, there are a few questions which are relevant to this slide, so I'll take one or two of them. One is about hedging. So when I say hedge is nothing but if something is going, you are suppose having equity as an investment, and if macro environment like due to Trump tariff or due to geopolitical situation or war, you feel that equity can go down, then that means and gold can go up because of this scenario. So if you take some portion of equity allocation to your commodity, it is known as hedging, because you're doing you're kind of taking a call in another asset class, or you are shorting equity also can be one of the way to hedge. So there are various ways in which you take a call to make to prevent the loss in your portfolio, you take another position. So that's known as hedging. So we have understood why we should do asset allocation. We have also understood what are the various type of assets classes which are there. Now, what we should be doing? You should be doing a strategic asset allocation. What is a strategic asset allocation? A strategic asset allocation, to put in very simple terms, it is mapping your long-term goals as per your risk profile and choosing an asset allocation which you are sticking for a very long term. Very long term means like 10-year plus goals. What will happen is, in this, what you should be doing, you should keep it constant throughout the market cycle. Now typically what happens is, if equity market is going up and suppose you choose, so I'll tell that in an example as well later, but let us say you start with 60% in equity and 40% in debt, and markets have run up, so 60 has become 70 and debt has become 30. Now what will happen is, you will say, no, my risk profile is aggressive. I can take 70-30 equity allocation risk, right? Don't change it. Don't change when you are taking the asset allocation call. Keep it constant, right? So how do you keep it constant? You have to rebalance. You have to sell 10% equity and buy 10% in debt, so that your asset allocation remains constant throughout the journey of market cycles. And use it for your mandatory goals like retirement and child education. And periodically you review it and change the allocation. What you should not be doing, I just covered that. You should not be changing the allocation based on the market noise. Your allocation should remain same throughout the market cycles. You should not be chasing returns just because there is something which is now in fashion, right? There are many a times what happens that now mid caps or small caps are doing very well, or they are not doing well, or defense sector is doing very well. Should I not take some exposure there? Don't do that in your strategic asset allocation. There is a place to do it. We will cover that later, how you can do that as well, but with a small portion of money. But don't do that here. Strategic asset allocation, you stick to what you say that you are going to do. And don't ignore the rebalancing. Whenever you see there is a 5 to 10% deviation, you rebalance. And don't use it for short term or tactical bet. And obviously, it is not about product selection, it is about asset classes allocation. It is not about product selection. So, it is a disciplined framework which will align to your long term goals with risk and stays steady across market cycles. Now, example of strategic asset allocation. So in a 10-year or 15-year time frame period, let us say a moderate risk appetite, person who can see a downside of around 10, 15 to 20%, he will be able to go with the 60 in equity, 30 in debt, and 10 in gold. Now, and you have to review and you have to rebalance. So we'll take a few minutes to just understand why rebalancing. It will actually keep your portfolio balanced. It will ensure very good discipline, and with a limited risk, you will be able to get a good return expectation. Now, why it matters? It matters because there will be some bull market runs or some very high amount of crashes like COVID, that you will be able to manage your behavior, and you will be able to also take a call according to your portfolio, not because of the markets. So that is important, right? So I'll again stress one thing. Many a time people get so much carried away by nifty returns, by friends returns, by what Trump is saying, whether BJP or Congress or which government will come in power. So all those decisions are not for you to take. You have to decide about your portfolio. Is it going overweight on equity or is it going underweight on equity? Accordingly, take a decision. It is your portfolio decision, which will be based on your portfolio situation, not because of what is happening in other macro conditions. So very simple example, 60-40 debt, to explain this rebalancing. After 2 years, let us say equity has grown up to 72 and debt has dropped to 28. So you have to simply do one thing, sell equity and buy debt and bring it back to 60-40. Now, I've just simplified it so that you understand the process. This is a guaranteed way of making money. Why? Because you are selling equity at a high level and buying debt at a lower level. And whenever equity market suppose falls, you will be selling debt and buying equity. So you will be always buying equity at a lower level and selling equity at a higher level. It's a fantastic way to make money in your long-term portfolio. So you are automatically booking profits. You're reducing risk in the market correction because you have booked profits already. Whenever markets correct, typically there is euphoria which precedes the market correction. And you are always coming and sticking to your original asset allocation, which is 60/40, or whatever is the asset allocation which you decide to begin your investment journey for long term. So it will always enforce you to buy low and sell high without any emotions involved, without any macro condition changes or what is happening or whether equity has run up or XYZ thing has run up. Doesn't matter. Another thing is now the tactical asset allocation. Now, in tactical asset allocation, what will happen is simple. You are trying to make use of some short term or a medium term opportunity. Now, for again, now I am saying you review everything, you see everything, valuation, macro trend, you define the entry, you define the exit, you take a tactical call for a very short period of time. So, what is a short period of time? Again, here it is not like day trading now, okay? It is not going in that dimension. It is like a 10-year period or a 15-year period, your strategic allocation is running. And now say you COVID has happened and now you believe that the equities have undervalued so much that instead of sticking to your 60/40 allocation, you want to stick to say 65/35 allocation. Though I have sold based on the market conditions, don't change it, but it is a tactical allocation which you will correct it within a year and then bring it back to 60/40 because you want to capitalize on something which you are seeing as a short-term opportunity for yourself. Now, typically, we don't recommend this to be done for your mandatory or your long-term journey. Keep that separate. Keep your 5 or 10% of allocation of money for your tactical calls and see how it goes because not you cannot do everything. You cannot do long-term strategy based investment and maintaining rebalancing and doing this and reviewing it on a yearly or a 6 monthly basis and do tactical also. So experiment and then do it, but tactical allocation will be something which you will we will take for a shorter period of time, typically less than a year. I'll just see if there are any relevant questions so far, so I'll take them. Rebalancing can be done half yearly or yearly, typically if there is more than 5% of deviation. So this is the exact example which I was talking about. I'll continue with the presentation now. The tactical asset allocation, 65% you deviated from, say 5% you deviated from 60 to 65 when they are seeing there is a huge correction in the market which has happened. But you don't replace tactical asset allocation. Basically, you don't replace the strategic asset allocation with tactical. So another quiz, why is strategic asset allocation suitable for long-term goals? Options are to trade market actively, to stay aligned with long-term risk and return. Third is to chase last year best asset class. And fourth option is to avoid volatility completely. Sahil, can you just put up the poll, please?
Yes, we will wait for more 20 seconds and then I think we can share the results.
Okay.
So I'm sharing the results with you, sir. So 5% has selected the first option, that is to trade markets actively. 82% has selected the second option, that is to stay aligned with long-term risk and return. 2% of attendees have selected third option, that is to chase last year's best asset class. And 10% is selected by the other attendees, that is fourth option, to avoid volatility completely.
Yeah. So I'll just show the correct answer first. It is to stay aligned. Obviously, the majority of you have got it right, and whooping majority of 82% have got it right. That to stay aligned with the long-term risk and return. You see, you're not trading. 5% of you have told to trade markets actively. It is not an active intervention. You don't do a change or rebalancing if it is not a sizable deviation from what you started with. So sizable is say 5%. So you need that type of a variation in your asset class to actually take any action. And volatility cannot be avoided completely. So I'll show that in historical returns in the next slide now, and it sets the context correctly. So if you see year-bound, this slide shows year-on-year returns with various asset classes ratios. Equity 20, debt 60, gold 20 in 2016. or all at equal proportion, nearly 34, 33, 33, or equity at 50, debt at 40, and gold at 10. Or there is another extreme where equity is 70, debt is 20, and gold is 10. So we will consider this gray one and this light orange one in our example to study it a bit more, right? Because there's a lot of uh, blocks here. So to make it easy, we will just focus on these two. One is having high equity, one is having low equity. So what is the volatility which is happening? If you see, equity is a volatile asset class. This is the one which is here at the bottom. Next year it is at the top. Then again at the bottom minus zero point 0.1. So you are not avoiding volatility completely by asset allocation. You are reducing the volatility by having an asset allocation. And then this goes up in this, then again 20%. But now you see in the last column, what is the average returns? Average return with this kind of an allocation is around 12.8%. This doesn't do any rebalancing and stuff. So with rebalancing, you will get another percent or more. But then this is the kind of return in a 10-year period. Now see this light orange one. It was at the top, it went to bottom, then again top, then second the top, and then down, then again down, right? So when it is down, typically when equity is running up like crazy. After COVID 2021, there was a bull run in equity. So that time the 70% equity allocation has performed 20% return, given 20% return when the equity markets have run up a lot. But then this portfolio allocation has given only 7% return. And the same thing, reverse is true when the markets have corrected a lot. In 16, 17, 18 time frame, the market was in a corrective mode. That time, if you see, there was a negative return given by equity portfolio of 70%. But this portfolio gave 4.3. So it is still positive. So now some people, especially young people, feel what's the big deal of 4.3% positive? If I have to get, I should get slightly more return only, right? So we should always choose this. So this I have told very casually one word, young people. So this young is means your risk profile is high. You have longer tenure in hand, and hence you can see this kind of downside to be okay in your portfolio. But be very clear that you have to have a longer time frame if your risk profile is high. So keep a longer time frame, and then you will be able to get a better return in a long run. But if suppose someone is retired guy who is not going to adjust to any negative return in the portfolio, he is actually comparing it with the FD safe return of 6-7%. That person is not going to tolerate any negative return for 1 year period. See, and because he will be withdrawing also from the fund. So for them, this kind of portfolio looks very good. So to cover on common frameworks, basically if someone is near retirement or he wants basically safer returns, then obviously debt allocation of more than 70% and equity of 30% makes sense. Same case for a higher risk appetite, younger people, especially who have more than 15-20 years of earning life left, and they can actually save periodically. 70% allocation, 20 in debt, and 10 in gold makes sense. So we have talked about asset allocation. I'll quickly cover something additional I wanted to give in this session to you all, that how do I construct a portfolio now? Right? Many a times people want that asset allocation itself is not enough. I should be now buying something, right? I should be putting into, say, large cap, mid cap, small cap. How should I be doing that? Equity, just saying equity is not good enough. So how do you do is you have to you have to have a clear thought process on asset allocation first, then choose funds which have very minimum overlap, and then see what is the overall cumulative performance of this whole portfolio put together, and what is the best in terms of the historical return which you can make an assessment for a longer period of time. And I'll strongly recommend you to see the second session by Harsh, in which he has covered how you should be comparing the returns with a rolling return basis, not on a point to point basis, not on just like past 1 year, 2 year. Even if you say past 10-year return, it is meaningless, because if the markets have run up a lot now and they are at a peak, everyone's 10-year performance now is very good. But when you see rolling return period basis performance, then you will find who is the real person, who are the real funds which are actually able to give you good performance. So I'll not get into the fund selection in this, but I want to give you a framework on how you can actually create a solid, sound portfolio. So you should have equity for growth, debt for stability, liquid funds for short-term needs, and gold ETF for hedge. Hedge meaning if equity markets are going to correct a lot, then gold will give you kind of a stability, because in that time frame, gold typically works better. Some mistakes to avoid, which we have seen a lot of time people do, that they will say that they have two equity funds, three equity funds, and they have diversified, they have a good asset allocation because they have three funds, but all three are equity funds. It is, and huge overlap of holdings as well. So you have to understand, in India, Nifty 500 is kind of covering 80% of the overall stock market cap which is listed. So if your two funds are choosing good stocks from Nifty 500 and they have huge overlap, it is no meaning to have multiple equity funds. You should have, but see that there is less overlap. One aggressive mid cap fund, one thematic fund, and they will just have one aggressive mid cap fund, and they say they have invested, or they will have one thematic because of the last 10-year performance or last 1 year performance. Those are not the way to invest. You have to invest based on your asset allocation. For that asset allocation, take some good 2 3 funds in each asset class and then create a portfolio. So that is how you will be able to create a sound portfolio for yourself for a long term investment. Now, each investment you should define a particular goal as well, right? Either it is retirement, or it is for your kids' education, or your own vacation plan after 5 years. It can be anything. But the moment you decide a role, you will be able to decide the tenure. The moment you decide whether it is a long tenure or a short tenure, you can define the risk, because if it is high tenure, you can take high risk, and therefore you can take say 70%, 20%, and 10% portfolio, which I talked about earlier. So I'm coming near to my closure of the session, in which key learnings are: risk and return will define, and the volatility is to be defined upfront, right? You have to define it in your portfolio upfront. You have to align the portfolio and the goal based on your own requirement. And then you have to have a disciplined framework of doing the rebalancing. Don't change your strategic asset allocation based on the market situation. It will have very high impact on your portfolio than product selection, because many a times what people do is that they will say, if you ask them whether you have invested in equity, yes, I have invested in equity. How much you have invested? I have invested 10,000 rupees. How much is your net worth, or how much is your thing which you have surplus? I have 1 lakh rupee, but I cannot invest 1 lakh rupee in equity, right? So it is not going to give you great return. If you have to understand, in a long run, the impact will come if you invest more, and you can invest more only if you have confidence on the strategy which you have chosen. And to have confidence on the strategy, have a proper asset allocation, and with discipline do the rebalancing. And if you do that, your downside risk is automatically reduced, because whenever the markets are in euphoria, you will be selling equity and you will be buying debt. And suppose you are starting now, right? So many a times people ask, right now equity looks to be high, right now gold looks to be high, how should I be creating the allocation now? You start small and build it over a period of time. It's like saying you will start small at 6 months time frame, you rebalance, and then you add more money into that based on the decision what is there. And at the time of rebalancing, maybe you just add the fresh money into the asset class which has reduced in allocation, rather than selling one asset class and putting. So you gradually build and invest the portfolio. It's a slow and steady process for generating wealth for a long run, and you have to add on a frequent basis. So last quiz on which is the least risky option for long-term investment. Among these options, one is 100% equity, second is 100% gold, second is 50 in equity, 50 in debt, and fourth is a cryptocurrency. Sahil, can we just pull up the quiz? Thank you.
Yes, so I'm sharing the results.
Sure.
So 8% of the attendees have selected first option, that is 100% equity. 10% have selected second option, that is 100% gold. 77% have selected the third option, that is 50% equity and 50% debt. And for 4% has selected the fourth option, that is cryptocurrency.
Got it. So people, I'll show the answer first. Obviously, this is the least risky. So we have just covered that. We began our presentation with this. Equity is having more downside volatility. Gold has lesser volatility than equity, and 50-50 debt portfolio will have even lesser downside risk. And risk is the probability that you will lose money in a short period of time, and you will see negative return in the portfolio, which is very less in 50-50 debt and equity portfolio as compared to these asset classes. Right now, for people who are choosing gold, right? So there is a sense of owning physically something with you, which gives you a sense of something which is not losing in value, which is fine. But when it goes down in value or it remains flat in value, there is a risk which you are having. And 100% equity can never be very, very less risky. It's never advised. And you should have some allocation to another asset class in your overall portfolio. Why I say that is, you have to understand that because I want you and everyone, and I do that for myself as well, I want everyone to make use of the volatility of the market. See, you have to understand, everyone wants the market to go up whenever you invest. As soon as you invest, you want the market to go up. But that will not happen. We have to learn that the market will be volatile. So how will I benefit from it? I'll benefit from it if I invest, and if market goes down, I have something to sell and buy equity because equity has gone down. And when markets run up, I should have something to buy again after selling equity because equity has gone up. I should always be always on a lookout. Where should I sell and where should I buy? In various asset classes, not in equity or stocks or within equity or this stock or that stock, right? Because that's an asset class. Because that's a very different game. The game which is played by fund managers, not by investors or advisors or people who are doing asset allocation based investment. So this is what you should take. The key takeaway which you should take from this is asset allocation and rebalancing is a free lunch which is available in the finance domain of investing. Please make maximum use of it as you can. And this is my very nice slide because it talks a lot about what is happening in the current market right now. AI is there, bubble is there, debt crisis, de-dollarization, and so on and so forth, and war and all that, right? You don't have to worry about till 2050 if you have 25 years of time frame to invest, right? Many of you will say, what 25? Who is going to live till 25? Who has seen that future? Please don't worry about it. You worry about 10 years. And 10-year also, if you want to worry about, then you do rebalancing. 7 years, that also is fine. But do asset allocation and rebalancing. So it is good investing is not about predicting, but it is about building a structure that works in all markets. And the thing which I am going to tell you is markets are volatile, they will remain volatile. What you have to understand, how do you make money off from the volatile markets? I'll take few questions. Sure. What should be the ideal asset allocation? So there is no such thing as ideal. It is depends on your own risk profile, how much, what age you are in, what is the kind of tenure you are looking to invest in, how much downside you can see in your portfolio. Okay, I'll give one example. Let us say you invest. I tell you that you invest your 1 month of salary, correct? And I ask you how much risk you can take. Most of us and most of our audience and whom I have talked to so far, they say it can go down 80% or even 100%. I am fine. Only 1 month of salary, right? It can go to zero also. I'm fine. I don't worry about it. And second is, if I say that your 2 year CTC is invested, your 2 year salary is invested. Now again, will you say 100% can go down? Most of the people say no, it cannot go down by 100%. It will go down very less, right? 10, 20, 30. That determines your risk profile, and which is different for each individual. And hence your allocation will depend on that downside, which you can see based on that asset allocation, how much downside I am okay to have it comfortably in my portfolio. So I'll refrain from giving any short-term market views. That's not the agenda of the meeting today. As a beginner, you should invest into, if you have longer time horizon, you should take 70-20-10 asset allocation, and you should move. That will work fantastically well. SIFs are a product which you should worry about after MFs. Let's start the journey with mutual funds, then SIFs you can consider. Image is talking about what is happening in the macro environment. If you have not read book by Stephen Covey, this is a book on 7 habits of highly effective people. I strongly recommend you to read that book, in which he talks about concentric circles, that is area circle of concern and circle of influence. Now, circle of concern is inflation is high, AI bubble is there, right? That is all your concern, and the market noise is there. But what can you do about it? You can't do anything, right? So that is your circle of influence. Your influence is on your own goal, on your own asset allocation. Just focus on that. So that circle of influence is what will give you result. So hence this guy who is shown in the picture is very clear. I have to worry about only asset allocation, and I have to worry about my own asset allocation and my goals. Rest of it doesn't matter. Because of rest of the story, there will be some impact and my asset allocation will change. It will reflect, and then I'll take a corrective action. How do you exit? Fantastic question. Asset allocation will help you to build this long term wealth. But when you have started with a long term journey, you have to understand that all long term goals will become short term in some time in future. So when they will become short term in future, you should be changing the asset allocation again, because as I have shown you that the short term goals or the goal in which people want lesser risk, that allocation should be high. So you should then reduce the equity portion and increase the debt allocation as and when your goal is coming near exit. So Siddhaish, Vani, your question, I hope you have answered that. I'll avoid the questions on crypto. I still feel it is something which is yet to see more traction in other countries than mostly other than US. Gold and silver, I believe, will you can have some 10 to 20% allocation in the long run. So that's how it has to be. Gold MFs are great to invest. That is an answer to Jason P. I'll just tell the names as well. How do we decide the asset allocation percentage? Name is not there. Motorola Moto G62. Any framework? So I have told you repeatedly, framework is your own risk profile. What is the downside risk? What is the tenure you have? And then decide what is the downside you can see in your portfolio, and based on that, decide your asset allocation. Yes, you will be getting a recording of this, Niranjan. Atul Behal, there are many good debt mutual funds, and in that also there are category of debt, that is liquid mutual fund, corporate debt, government securities, GSEC. So you get such options, and you can choose one of those to invest into debt. Yes, Rajiv. Typically, you should stick to one or two fund in each category and not go beyond that, because portfolio overlap otherwise is very high typically in a same category of fund. Just to give you an example, say a large cap fund. So SEBI has already decided and told that top 100 stocks of the country are known as large cap. So if you are having a location in large cap fund, you will be and you choose multiple large cap, there is a high chance that there will be high overlap among their selection of funds. Dhairya Gupta, yes, fantastic question. One theory is not to try and time the market. So if equity has a rally and we feel the market is at peak, which no one can predict, and we shift investments to that, isn't it timing the market? Also, won't there be LTCG tax? Yes. So first is there will be LTCG tax, and LTCG tax is something which you have to pay anyway. If not now, at the time of rebalancing, maybe at the time when the goal comes near and it is matured. So what you are doing is, I'll explain this. Now, let us say 10-year period, you invest one time and you exit only after 10 years. So you will pay say I'm just taking an example, say there is a gain of 1 lakh rupees at the end. So in that 1 lakh rupee, you will be paying the LTCG tax. Okay, 1.25 lakh is tax free right now. So let us take 10 lakh rupees gain. So 10 lakh rupee, you will be paying LTCG gain. But in middle, if you book, say, profit of, say, 4 lakh rupees, then from here on, next 5 years, you will pay tax only for that remaining 5 year gain, what you will get, not for the first 5 year, which you have already booked. So, not much of a negative if you do rebalancing and you pay long term gain taxes. Atmaram Bavaskar, yes. So I actually don't recommend at all to do stock selection and for long-term investment. You should stick to funds, and there is a reason behind it. And I'll tell you what is the work which is involved when you say I want to do a stock selection. You have to understand the work. The fund manager is actually attending the AGMs, seeing the quarterly reports of the companies, what he is having in his universe, attending them, making a view how is the next few years earnings look like, and then he decides to whether take a holding a particular stock or not. It becomes too much of an involved work for individuals like us to do that, or you have to do it and make it as a full time for yourself. Better is to stick to a fund manager who is doing his job well, and you manage asset allocation. You manage whether equity as an asset class is doing well or a debt as an asset class is, or what is your asset allocation for a strategic for long term, which you should have. And you give your money to these fund managers to manage. So they will pick stocks on your behalf. So you have to understand what job you are doing. You cannot do all jobs. You cannot do stock selection job also, asset allocation job also, and your own job where you are earning money also, right? So it becomes too much. So give that job to fund manager. That is the best thing to do. Ulvesh Patel, I didn't get what your question is, but I think there is a way to 100 minus age is okay for equity. You see, these are all frameworks to tell you and introduce you about asset allocation. What you should be comfortable is what is the kind of downside risk which you are exposing in your portfolio if you follow this. And are you comfortable with that? If you are comfortable with that, fine. If you are not comfortable with that, reduce it. And if you can think you can take slightly higher than this risk, then please increase the equity accordingly. Yes, Nikhil, we should be doing Nikhil Chalker, we should be doing rebalancing either on a 6 months or a 12-month basis, or whenever there is a more than 5% change in your asset allocation. Shirish Mule, multi-assets is a good category of funds which has come in the market. Very recently, it has got a lot of craze and attention, though they are there in the market for long. And primarily because of the recent run-up of gold and flat equity markets, their performance currently is good. And you can choose a multi-asset fund instead of doing this asset allocation yourself. But you should be comfortable again with how they are putting in multi-asset, what is the allocation they are having in various equity, debt, and gold, and international also. So by the way, I have not covered one asset class which is known as international equity. And that also gives a good diversification in your whole portfolio. And you can choose multi-asset, but put then your sizable money in one multi-asset fund to get the gains on this. Just don't do it for the flavor of having it in your portfolio. Book name was Stephen Covey, Seven Habits of Highly Effective People. Yeah, Samrik Chakravarti. Sector specific, I'll leave it. Samrik, again, 70, 20, 10 is 70 equity, 20 debt, and 10 gold. Shailendra Kumar, again, interesting question on why should we use any 50 EMA, 200 EMA indicator to accumulate asset class. So again, you are getting into a territory of a fund manager, correct? When I should be buying a stock, when I should be buying something else. You go with your own allocation and make it simple. If you make it simple, it is easy. When I'm saying make it simple, that is you go with say 50-50 allocation also. Then if your 50 becomes 55 and debt becomes 45, sell 5 and get into this debt, or other way around. So these DMA indicators and all, you keep it as a practice or some other portfolio. You keep it to experiment and try it out. What I have seen is to put high amount of money of your hard-earned money for long-term goal and sizable money, you need to have more confidence, and it is easier to get confidence on asset allocation based strategies rather than any other DMA based indicators and so on. Yes, an anonymous attendee, why only gold, why not other commodity? Yes, you can invest into gold, silver, And other commodities, then these two, it's not easily available for anyone, a retail investor, to invest in. So that's why it is a bit tricky. Yes. Yes, Samir Sadeshmukh, it is completely necessary to rebalance and adjust the debt equity. The ultimate aim is to reduce the risk on the portfolio. If equities have run up, when they will correct, you will just see the paper gain only. You have to book profits also. And when equities crash, you have to buy equity at a lower level also. So you should sell debt and buy equity when the markets crash. Best book to read as an investor, there are many books which are great books. For Warren Buffett series, which he writes letter to the investors, is good. And for many of you, I think Monica Halan will be a good author to follow. This is an See, many a time people feel that I have started late. I am near retirement, only 5 years in retirement. Can I start now? You can, but it will take some time for you to adjust to the market equity and volatility. Sahil, I don't know. I cannot cover all questions. I think there are a lot of questions still.
Yes, sir. There are many questions.
I'll just try what best I can try.
Also, I want to answer one question regarding the recordings that I can see most of the attendees are asking for the recordings. So please visit NISM YouTube channel or just type in NISM YouTube channel in YouTube search bar and head towards the live section. And in first 4 to 5 videos, you will be able to find the past 2 episode recording. So you can watch that recording. Yes.
Okay. One more question. Some people suggest me to deposit the bulk amount in senior citizen saving schemes 8% per annum. Should it be advisable, or do SWP will be the right way? You see, you are getting 8%, but you have to understand it is fully taxed. If you are at a 30% tax bracket, then you have to see what is a post-tax return. And if you are only solely dependent on this money, then you have to see that whether this will suffice you for the remaining of your tenure or not. So don't go by greed, go by your requirement. What do you need? And then only choose to decide any other mutual fund or SWP or anything. If you need to take risk, then it's a different matter. But if you don't need to take risk, it is good scheme to continue to hold on. Sushma Das, cryptos are not discussed because of its legality in the nation. You have to follow the law of the land, and if RBI is not making it easier for people to invest into it because of XYZ reasons, that then it is not a investment vehicle, because I don't know when the money withdrawal will be banned by RBI or anything. So I don't want to invest into something which is not a whose future is not legally so certain. Vikram Rao, I think your question will determine more work. It cannot be answered just like there's a Q&A, so I'll pass that. Another question is on how are ESG and sustainability related MF to invest in. So these are all again theme-based investments. You can have certain allocations, say 5 to 10% in your portfolio, but it should also qualify under the equity as an asset class. So you have to follow and maintain the asset class and do the investments accordingly. Biju George, it is good to diversify among various funds, provided the fund among themselves don't have so much of overlap. Thank you, Sandeep Kandhari ji. You liked the session. SIP is good option for investment for college students. Anuj Yadav. So again, I have told again and again that it depends on your own goal and what is the tenure you have. Whether you are a college student or you are going to retire very soon. Actually, it helps to know your mindset, but what it doesn't help is how much risk you can take. So why are you investing is important. So first, goal will define tenure will define risk will define what is the kind of return you can expect. So these three things go always in this order. Absolutely right. Whosoever has written it, we can say that long-term asset allocation is primary phase of wealth generation. Yes, Shashidhar MK, very good question. That if you rebalance every 6 to 12 months, then will ST short-term capital gain will be very high. So yes, you can rebalance in various other ways. I am just giving you a very simple way of selling equity and buying debt. But suppose you have fresh bonus or some more salary increase, and now you can rebalance by putting money, additional money into the asset class in which it has lost the percentage, rather than selling equity. So that way again you save on short-term capital gain as well, and it solves your problem of where to deploy further money into the whole thing. So your asset allocation can be balanced by purchasing and deploying fresh money as well. You always you can start investing in the markets. You don't have to wait as such, because you will start small and start with say you have X amount, you start with a smaller amount and follow the asset allocation and rebalance it 6 months and then add. I'm skipping a lot of questions which are directly fund based questions. So fantastic question. So this is an important question. Srishti Rao, is it good to have a lot of money in select 4 5 mutual funds? What if the AMC goes bankrupt or has some issues, and should we put in several MFs then? Correct. So now you have to understand the structure and of MF. MF is just managing the funds, but they are eventually buying a stock from your money, and they are charging their own fees, and it's a trust structure. So trustees are ensuring that the fund managers are paid the fees. So AMC is the one who is managing your fund, and they are charging fees of managing your money, but they are eventually buying stocks. So even if AMC goes bankrupt, in all probability they will be having stock holdings which are again with the CDSL and NSDL in that framework, and you will be able to get your money. So unlikely that your money will go anywhere. Okay, I think I have tried to answer, Sahil, most of it. The time is also up. So I'll just cover the last two slides. You can reach out to a SEBI registered investment advisor for unbiased fiduciary and financial advice. And ARIA, I'm a member and director in ARIA, Association of Registered Investment Advisors. So NISM has collaborated with ARIA to do this investor education webinar. And where can you find? You can search in Association of Registered Investment Advisor members directory. You can also go to SEBI investment advisor list, or you can also go to BSE website to get the members list, where you can get an RIA near you. So that's the end of it.
Yes, thank you. As we are done with our third episode of Foundations of Financial Planning series, we would like to express our sincere gratitude to our speaker, that is Mr. Shailendra Kumar sir, for sharing his time and knowledge with us. Also, thank you to everyone who joined us, and we look forward to welcoming you to the fourth episode of Financial Planning series, scheduled on 22nd January 2026, that is on next Thursday. The topic will be goal setting and planning, and the session will be conducted by Ms. Renu Maheshwari. Yes, thank you all. And before leaving, I would like to request all the attendees to stay in for a few more minutes, as we have with us Dr. Miraj Inanda, Program Director and Assistant Professor, NISM, and he will be going to discuss about the NISM FPSB Financial Planning course. Yes, over to you, Miraj sir.
Okay. Thank you, Sahil. Am I audible?
Yes, sir, you are audible.
Okay. First of all, very much thankful to Mr. Shailendra Kumarji. He has given a very much insight on the financial planning. And ARIA is a very consistent support in our different initiative, and especially in a PGPFE program also. We had called earlier the ARIA members to deliver a particular session. I was also listening the Q&A session, which is very insightful. The people asking about taxation, means security analysis, portfolio rebalancing, and mutual fund selection. So those who want to do deeper knowledge in the personal financial planning, so we are introducing you this PGPFE program, a new batch. This is actually second batch. One batch is already going on. And this program is in collaboration with the FESB India. So why financial planning? I think through the Shailendra Kumarji discussion, also you have got the idea. Okay, there are the demand for the financial advisors, financial planners, those who can serve for those who want very insightful advice on their wealth management. So right now, as we are having almost 9 crores of the SIPs, and lots of people have, especially post-COVID, has joined the securities market, and they want very professional advice. So through this course, we are planning to prepare the financial planners to fill this gap. As you know, the NISM is established by SEBI, and we have a campus at Patalganga, and we have 1,000 plus alumni. The certification, if you see, the more than 4.5 lakhs people every year do the NISM certification. FESB India is the international body which provide the CFP certification. So they have 2,23,000 2023 700 CFP professional worldwide, and they have been recognized in more than 28 countries. And in India, they are having 2,800 professionals. Most of them are the SEBI registered investment advisors. Um, about this program actually a 12-month program divided into 4 semester. The total hours are 360 hours. This is the online weekend program. So those who are this working professional, those who want to make a career in financial planning, wealth management, so they can opt for this course. The this course also included the on two campus immersion, means you can come to the campus Patalganga and ISM, and here also you can spend almost 5 days and also interact. You can interact with the faculty. Here, the specialty of this program is that here you are having a 5 NISM certificate embedded into this whole curriculum and 4 FESB mandatory certificate. So altogether, there's a 9 certification included in this program. So online teaching, that is 360 hours teaching, and plus this 9 certification. Because if you want to become an investment advisor, so you must have the investment advisor IS certification of NISM. Plus, you need to register with SEBI. So here, that certification also we are providing, and is providing means you need to go through the curriculum, attending the class, and appearing for the certification. And simultaneously, the FESB curriculum and their certification is also there. So here you are having a regulatory means compliance with the NISM certificate as well as the global recognition through the CFP course. So if you see the curriculum, so you will find the CFP modules like investment planning, risk estate planning, retirement planning, and tax planning. And specialization is also, we have curated, means how to do a securities analysis, mutual fund, fixed income, ESG integration, like somebody was asking about how the ESG mutual fund works and all. So this comprehensive curriculum we have designed in perspective of to give a personal financial planning, and the learning outcome, what I have discussed related to this module. And the another important thing about this course is the faculty and industry experts. So as this is the joint program, so most of the faculty are the NISM faculty for the NISM module, and CFP qualified CFP people for the CFP module. So, and most of the CFP people are the industry practitioners in the investment advisory services. So we are also calling people from the SEBI if any compliance related teaching is needed. And all of the teaching is designed around the case studies and discussion and classroom teaching. Campus immersion also we are talking about. So here we generally discuss about the behavioral finance, leadership, communication skill in the investment advisory service domain. So this actually it is a 5 days, 1 week. So this is also included in this course. The fees and your stay in the campus, everything is included in this. And also we provide library access to the student, alumni status, and etc. So what are the eligibility of this course? So eligibility of this course is you must have 50% marks in any graduation. You need to apply for this course, and you need to appear for the interviews. So that is the process of taking admission. And the class is generally scheduled on Saturday and Sunday. Every month, 3 weeks will be the classes. 1 week will be the holiday. So six to 9:15 and 10 to 5:15 means two session in the Sunday generally we have it. The fees are very competitive, so 3,18,000, including all the GST, 9 certificate, campus immersion, access to library, alumni status, so that all included into this fees. So now the applications are open for this course. This application is open till 20th March 2026. Interviews will be going on between interviews letters will be sent between to 6 to 9 April, and the classes will be start from the 16 May 2026 online. So, what are the career opportunity through this course? You can become a financial advisor, relationship manager in bank and advisory, wealth manager in private banking and asset management, investment advisor, research analysis, insurance and risk management, and professional. Research analyst, if you clear that research analyst certificate of NISM and the register. But investment advisor level 1, level 2 is also embedded into this course. So this is an online course, so the placement is not in this course, but yeah, so CFP have their portal for various openings continuously. So as I was discussing, this is the locally adhere with the regulations of the market as well as a globally recognized because of CFP certificate. And it's an online and weekend course and having a industry faculty and 9 certificate. So this is our first batch where we are having a 38 students who have enrolled for these courses. And as far as third semester is going on, and as first and second semester, the passing percentage of the certificate of NISM is almost 97%. Passing percentage of the CFP certificate is 78%. That means for this 2 semester I'm talking about. So these are the faculty. Some are the earlier member of the ARIA and various successful financial planners. So these are the pictures from the immersion week, which held in the NISM campus. And this is generally the online classes look like. And that's all from this PGPFP program as a program director of this program. Uh, I encourage you to visit our website and download the brochure for more details. And also, you can write to this email ID pgpfp@nism.ac.in. Again, I'm saying the program is a postgraduate program in financial planning. Uh, and these are the number you can call and take a more information. That's all from my side. If you have any question, you can put here. And thank you very much for listening to me.
Thank you, Miraj sir. I think now we can end this session. So,
Thank you.
yes.